Netflix warns on subscriber growth, pushing that stock down. Will it affect the rest of the market today? That's coming up on 3 Minutes on Markets and Money. Yesterday, Netflix warned on their subscriber growth, seeing subscribers actually drop by over 2 million. Now, that's really the first big warning that Netflix has had here for a while, but it may be indicative of what's happening with subscribership for a lot of the other streaming companies. Now, just really too many subscription services in that space, the competition too high, starting to cannibalize each other. That may be a problem we see coming up in companies like Disney and others in their earnings reports as we go through earnings season. This morning, stocks are kind of shaking off that bad news because we've had a lot of earnings come in this morning. Procter & Gamble boosting their sales forecast. Abbott Labs, Tesla reporting their earnings after the bell today. And on that, we have seen futures turn around this morning. Following through, we had talked about on Tuesday that the Monday sell-off was really not surprising as investors had to sell shares of stocks to pay their tax bill that was due on Monday. That typically leads to a rebound in markets following tax day. We saw that yesterday, and this is something we had touched on previously about stop losses, that we had broken the 50-day moving average, and technically if you break the 50-day and that was your stop loss level, you sell out of the stocks. We have said before to be careful with that. What you want is a confirmed break, and we never really had a confirmed break at the 50-day moving average. Yesterday, markets rallying sharply above that. Look to get some follow through today. We'll see how that goes. The markets are in a good position now to give us a rally back to this previous peak that we saw earlier in the month. And markets are turning positive here. We are seeing that oversold condition begin to turn up. We've got a very short-term buy signal. We're watching our money flow indicator. It's beginning to improve here as well. That is all suggestive, and combined with very negative sentiment, that's all suggestive that we could see this rally kind of continue here over the next week or so, particularly as we get into the bulk of earnings season over the next 2 weeks. Lots of companies going to be reporting. Earnings still should be fairly favorable for a lot of companies in the first quarter because all that liquidity that we had that was in the markets last year, the remnants of that now kind of coming out in the first quarter. Now, once we get into the second quarter, third quarter, inflation, less liquidity, less consumer spending, that's going to show up in these earnings reports. But the key thing to watch here over the next 2 weeks in these earnings reports is really about the guidance going forward. Watch what these companies are saying about earnings growth, what they're saying about profit margin growth. That's really going to be the key to a lot of these companies. And with most companies extremely overvalued, Procter & Gamble is a good example, a value company in classification, but not really a value at all, trading at 5 times price to sales. A miss in some of these very overvalued companies, we could see more repeats of the Netflix type drawdown where you see a 20-25% decline. So make sure and review your portfolio. Look at companies that may be negatively impacted by higher inflation, less liquidity, less consumer spending. Those could be very vulnerable to sharp drawdowns if they have negative guidance in the earnings report. I'm your host, Lance Roberts, for 3 Minutes on Markets and Money. See you back here tomorrow.